system will notify you once you begin your broadcast. The broadcast is now starting. All attendees are in listen-only mode.
All right, well, welcome everyone to this morning's webinar, Find Hot Stocks and Avoid Big Losses with These Simple Techniques. My name is Tyler Ballhorn. I'm the founder of Stockscores.com. I've been trading the stock market for 33 years. I've been teaching others how to trade the stock market for 23 years. And I'm going to give you the overview of what I do and how I do it and that sort of thing. So, like I said earlier, it'll take probably 45 minutes or so to go through everything. I think you'll find it very insightful, and you'll have some real good skills to use for, again, finding the good stocks, but also avoiding the bad ones. All right, so what I'm going to start with is just teaching you the basics of stock charting. I use the term stock charting rather than technical analysis because I'm not a big fan of a lot of technical analysis. I think you just use some simple techniques that really anyone can do with a ruler. You don't need a lot of knowledge of math or all of the complex indicators that make up that world of technical analysis. I'm going to teach you these 7 things this morning, and they're going to provide the foundation so that when we start looking at charts, you're going to very quickly be able, with some practice anyway, very quickly be able to figure out what is a good company, what is a bad company, what is a good opportunity, how to manage risk. All kinds of things will fall out of just understanding these 7 things. All right, so you can see them there, inflection points, which are kind of like the building blocks of chart patterns. And then once we understand inflection points, we can start drawing lines across them. And those lines define optimism, pessimism, support, resistance, price volatility, abnormal activity, and trends. So what I want to start with is sort of a blank page here. And from that blank page, I'm going to draw some things and sort of bring these concepts into play. And then what we'll do is we'll look at some charts of actual markets or individual stocks. And I'm going to show you when the buy point was, when the sell points are, how to know when a stock is risky, all that sort of thing. All right, so we're going someplace, but we have to start with some simple stuff. All right, so a typical stock chart, will have a downward trend, and then it'll stop going down and it'll start going up again. And along the way, there are these peaks and valleys. So we call these peaks, obviously, and these are valleys. And I call those inflection points. It's really the point where the stock stops going up and starts going down. That's an inflection point top. Or stops going down and starts going up. That's an inflection point low. So we call that a low point or a high point in terms of inflections. Okay, so that's the first thing. And again, I'm going to give you this quick overview, and then I'll show you on actual charts how this plays out. So you have these inflection points, and it's really where direction changes. So the stock's going up, stops going up, starts going down, you've made an inflection point high. Stops going down, starts going up, you've made an inflection point low. What we can do is we can draw lines across those to define who is in control of the market. If the buyers are in control, if there's optimism in the chart, you have rising bottoms, rising inflection points from left to right. So here we can say that the buyers are in control, and that is optimism. On the other hand, we have falling tops here, so we can say the sellers are in control, and that is pessimism. That's really, really important. You don't want to be a buyer of a stock if there is pessimism, because the sellers are in control, and it's much like trying to paddle a canoe up a river. You could do it, and sometimes you'll find a stock that can do well in a down market, but most stocks are going to move lower if there's pessimism. It's only when you switch from pessimism to optimism, when you start to build rising bottoms from falling tops, that you have a buying opportunity. And I'm going to show you an example of a stock that everyone has heard about that did this last week. I'll show you that in a minute. All right, so we have inflection points, we have inflection point lows, we have inflection point highs. And we can draw lines across those to define who's in control. Buyers are in control if there's bottoms rising. Sellers are in control if tops are falling. Now, we can then also look at these inflection points to define areas of support and resistance. So if a stock chart pattern looks something like this, and we have repeated hits of the same price, we draw a line across that. That line is called resistance. It's a ceiling price. And it's marked by high points, typically that the market hits multiple times. So these are all inflection point highs. And if you hit them a few times, you have resistance at that level. Now, a low point on the chart, like this one, is called support. And any inflection point low can be considered support. So the most recent support for this stock is right here. That's the last time that the stock stopped going down, started going up, and made an inflection point low. So any inflection point low will be an area of support. But the ones that hold up for the longest time period, they're the most important. So this one here doesn't hold up for very long because it hits the line over there. So this is, I would call this minor support, this one right here. And this is major support because it's held up for a very long time. Right, so that's now support and resistance. So from our checklist, if we go back to our list here, we have inflection points, optimism, pessimism, support, resistance. Now we're going to talk about price volatility and abnormal activity, and then we'll talk about trends. Okay, so let's go back to my little whiteboard here. So you've got price volatility and abnormal activity. If we go back to drawing this pattern that looks like this, these waves up and down for this stock define how volatile the stock is. So the volatility in this time period is greater than in this time period. So let's imagine we put some prices to this. So let's say this is $10. The stock is at $10 here. It goes up to $20, and then it falls down to $15, and then goes back up to 20, and then down to 18, and then back up to 20, and down to 19. You'll notice that here, the price swing is $1. Whereas over here, the price swing is $5. So there's a lot more volatility over here than there is over here. And there's a reason for that. When there's a lot of volatility in price, it is because investors are uncertain about what the company is worth. You have to remember that the stock market is a place where people are, arguing about what the stock is, or what the stock or the market is worth. And the more volatile the stock is, the more that argument differs. So if you go from 10 to 20, that means that the buyers and sellers really don't have any agreement about what this company is worth. But over here, you're trading between $20 and $19. So the buyers and the sellers agree or understand that that stock is worth somewhere between $19 and $20 a share. Now, this is going to become really important when I start showing you some real examples and teach you how to predict where stock prices will go. Now, I know that there's a lot of information here, and I'm kind of zipping through this, and we're going to revisit these things in a moment. But just understand that this whole lesson is being recorded. I'm going to send everyone the video. You're also going to get an e-copy of my book. So you're going to have lots of resources to go back to make sure you understand these things. So stick with me. It'll get simple as we go along. All right. So that's price volatility. And so if we were to, draw this pattern again, if I draw a line across the bottoms, that means there's optimism. Draw a line across the tops, that's resistance. We could color code them. We could say resistance is like a ceiling, so we'll make that red. Optimism is like something green. So we've got optimism, and we've got resistance, and we've got volatility that is compressing over time. There's more volatility here than there is over here. That means investors over here are confident about what the stock is worth, and over here, they are uncertain about what the stock is worth. And then the final thing that we want to think about in this chart is abnormal activity. If this stock is trading between $19 and $20 a share, and then one day it breaks out to $23 a share and does a price move that really stands out relative to this volatility, in other words, it jumps up in volatility all of a sudden, that is abnormal activity. All right. And that's abnormal activity in terms of price. Now, when you look at a stock chart, you'll also have volume traded, right? So you'll see the volume bars along the top, and I'll show you this on a real chart in a moment. And then all of a sudden, the volume might also jump up. Now, ask yourself, if everyone in the market agrees that the stock is worth somewhere between $19 and $20 a share, and that the investors are optimistic because every time the stock goes down, it can't go as low as it had the previous time. And so that's why we get these rising bottoms, which represent optimism. So if you have those things coming together, you have optimism, you have low volatility, and then you break from that with a lot of volume. Why do you think that happens? What's happening is that all of a sudden, something has made the buyers excited and willing to pay a lot more than they had been willing to pay for many months in this case. You know, no one had been willing to pay more than $20 a share. And then one day they're willing to pay up to $23 a share. And the volume that jumps tells us that there's lots of people doing that. And those breaks are caused by people that have new information, and typically it's information that most people do not yet have. So it might be, you know, someone that really has done some great research on Apple and knows that Apple's earnings are coming in a week, and they've, you know, sat outside of Apple stores. This is what hedge funds do. They'll hire people to sit outside of stores and count traffic, and they, you know, do channel checks. They check with the producers of the components for iPhones. They do all this very costly and in-depth research to try to figure out what earnings are going to be before the earnings are announced. And when they do that work, they might say, you know what, looks like earnings are going to be better than we expected 2 months ago, better than the market expects given the drop in Apple's share price over the last 6 months, let's say. And so that's when they come in and buy the stock aggressively. It's these large funds that can do much more in-depth research because they have the financial resources, they have the expertise, and they're the ones that start this abnormal activity. They're the ones who have this willingness to pay more than anyone had been willing to pay for some time. And the reason simply is that they have better information. I don't have better information. You probably don't have better information. Maybe within the company you work for, you might. But to have better information about every company in the stock market is impossible. But guess what? The market never lies. The market will tell you when that group of investors that has better information is acting in the market aggressively. And it does so with abnormal activity. Now, if you've watched my videos on YouTube in the last little while, you'll know that I often talk about alpha. I talk about stocks needing to have alpha if they are going to beat the market. Alpha stocks are those that are trading on their own story. They have significantly better fundamentals. They have improving fundamentals. Their business is getting better, or I should say the perception is that the business is getting better. You have buyers coming in and acting aggressively because they have some information that justifies paying a higher price, and that is ultimately what sends stocks into upward trends. And as more and more people learn about whatever information drove this price action, more and more people will buy, and that's what sends the stock up. And so 2 weeks later, the stock might be at $30. You're buying with the smart money at $23, you've made a nice profit. And you don't have to have any knowledge of what caused people to buy on this day when they suddenly were willing to pay more. You don't have to have any knowledge. All you have to do is know that they're not idiots. People don't pay more for a stock unless there's a good reason. And so I will tell you that almost all market-beating stocks, those stocks that really make strong moves, 95% of them will start their market-beating trend with abnormal activity. So that's really important. If 95, and I'm just guessing at the number, it's a high number, 95% of all market-beating stocks, so stocks that go up a lot, they start with abnormal activity. The problem is not all abnormal activity leads to market-beating trends. You know, you could have a stock that's been going up for a while and makes an abnormal day and then ultimately goes down. We need to be able to differentiate what abnormal activity is important. And that's what I'm going to teach you today. But hopefully you're starting to get a clue. When stocks break from optimism, from low volatility, with abnormal activity, that often leads to market-beating trends. And if you see that happening, then you know that there's a good opportunity there. The problem is there's thousands of stocks on the market. We need tools to find these things. And that's what I built 20 years ago. So Stockscores.com, my website, has a tool called a market scan that will look for stocks trading abnormally. And then for day traders, for those who want to be much more short-term oriented, we have some other tools using a program called TradeStation and some indicators for TradeStation that I created that will find abnormal activity in a very short-term time frame. So if you are an investor, longer-term trader, you're going to use a tool like Stockscores to find these stocks quickly. If you're a day trader, you would use something like the Stockscores Active Live service, where you can get real-time analysis of the market seeking abnormal activity in 1-minute increments. So very short term. And so on Tuesday, I will elaborate on all of this when I do the investor webinar. So again, go to Stockscores.com and you can register for that there. It's free. And then on Thursday, for those that are more interested in day and swing trading, I'll show you the tools that I use for day trading and swing trading. Okay, but today we're sort of building that foundation of knowledge. Now, the last thing I didn't talk about is trends. Let's just quickly describe a trend. So if you've got rising bottoms on the chart, you can draw a trend line across those bottoms, and that is an uptrend. Pretty simple. If the trend line goes steeper and steeper, that's called a parabolic trend. Parabolic trends are very risky because they usually result in a crash back down to the upward trend line. So you never want to be a buyer of parabolic trends. I was talking about that during the Money Talks podcast today, and that's what it is. You know, it's just the prices are curving away from the trend line. I'll show you some examples of that in real world stuff as well. All right, so let's look at some charts. So if you want to learn how to read charts, I've just told you everything you need to know about how to read charts. Doesn't have to be more complicated than that. It's a skill. It takes time to practice, and there's certain things you need to learn about what makes an opportunity a great opportunity. And I'll talk more about those things on Tuesday and Thursday's webinars. But for now, let's just start with inflection points. So if you want to find inflection point highs, what do? Just look for peaks. So there's one. Let me make that in blue here. There's an inflection point high. There's one. There's one. Anywhere there's a little peak, just put an X on it or something like that. Okay, those are inflection point highs. And if you want to know inflection point lows, those are the valleys. So here's one, here's one, here's one, little one there. So anywhere that there is price stops going down and starts going up, that's an inflection point low. Stops going down, starts going up, inflection point low. stops going down, starts going up, inflection point low. You can see lots of them, right? Okay, so that's step one in evaluating a stocks chart. Now we can start to draw lines across those to figure out who's in control. So if the highs are falling, then the sellers are in control. Okay, so sellers are in control, sellers are in control. When the bottoms start to rise, now the buyers are in control. Now, do you think you want to be a buyer when the sellers are in control? It's hard. It's not likely to succeed unless you get really lucky with timing. I always like to wait for the switch from sellers in control to buyers in control. I want to see when the buyers take over. So there's a double bottom here. You stop having falling bottoms, and then you start switching to rising bottoms. And then ultimately you break out, do this in blue, you break out through resistance from a bottom that is higher than the previous one. So you have optimism. You've got abnormal activity there. You see abnormal volume. You see abnormal price action. That stock is $12 here in the middle of September. And then on Friday, it closed at $16. So it's gone up 33% approximately in 6 weeks. I have no idea what this company does, couldn't care less. All I know is that the buyers started to act aggressively there for a reason. The people that know the most about this company were buying there at the breakout through resistance from low volatility. We had sideways trading, quiet sideways trading, from optimism because we had rising bottoms, with abnormal activity. We had abnormal volume, abnormal price movement, and that started the upward trend. Let's look at another example. This is a day trading stock. This is a stock I day traded on Friday, AGLE. Now this chart, the last chart we were looking at was a daily chart. This chart is a 1 minute chart, very short term, but it takes in the same concepts that we've talked about. If you can, evaluate a chart for the long term, for what you might put in your retirement savings account or something like that, you can also evaluate a chart in the short term for a day trade. Some of you may just want to manage your retirement portfolio. I'll teach you how to do that on Tuesday. If you want to make a career out of trading the stock market, part-time or full-time, I've trained hundreds of people how to do that as well. So this is and we'll do that on Thursday. So here you've got your rising bottoms, right? So who's in control? Buyers are in control. Buyers start getting in control right here. Up until that point, the stock was dead. It starts to trade abnormally there. That was Thursday afternoon, about an hour before the close. And then Friday morning, it gapped up. And then it gave us a buy signal on a strategy I use called a intraday pullback play. So one of my strategies that I teach in my active live or active trader course is called an intraday pullback. And it gave a signal right there. And I've got algorithms that identify these things as they happen. You don't even have to do much work for it nowadays because I've automated it all with computers. And again, I'll show you more of that on Thursday. But the key thing here is the buyers are in control, sellers are in control, buyers are in control. And so we have a buy point here, we have a buy point here, we have a buy point here, we have a sell point here because the trend went parabolic, right? Here's our trend line. We just draw the trend line for you. So we were way above the trend line. We went parabolic and then broke down. So you always want to sell at the first sign of weakness when the parabolic trend is broken. We'll come back to parabolic trends in a moment. All right, so how do you avoid big losses? Most traders are always focused on making big wins. And obviously we're interested in wanting to do that as well. But I want to emphasize that it's more important to avoid big losses because no one is going to be right all of the time in the stock market. And so you need a methodology that allows you to identify where you should take the loss. From this day forward, I hope that every one of you will plan to lose on every trade. Not that we want to lose, but we should always plan where the exit door is. And what we do is we first determine where the exit door is. So if we have a stock that's breaking out of a pattern like this, which is called an ascending triangle, so if we buy here, we should plan to lose at the last inflection point low, right about there. Generally speaking, we have some variance with that, some detail that we get into in my courses, but that's the general concept. So we call that risk. The difference between what you pay, so let's say you're paying $23 and your stop loss point is at $19, the risk of this trade is $4 per share. You're buying at 23. If it were to fall down through 19, you're going to take the loss. And so you stand to lose $4 per share. If you buy one share, your risk is $4 plus whatever commissions you pay to your broker. If you buy 100 shares, then your risk is $400. If you buy 1,000 shares, your risk is $4,000 plus commissions and slippage. How many shares you buy is based upon how much you are willing to lose. Most people buy based on how much cash they have to spend. So they look in their account and maybe they've got a $100,000 retirement account and they've got $12,000 of cash there. So they say, well, I can afford to buy 400 shares. And they don't really give consideration to their emotional damage that might come from losing $500 or losing $1,000 or whatever. And so one of the key things that I focus on when I'm teaching people how to do this stuff is understand your risk tolerance. How much are you willing to lose on any one trade? And that's going to be different for everyone. It's a function of how much capital you have, but it's also a function on your emotional makeup. It's a function on your age. You know, obviously, if you're in retirement age, you want to preserve capital much more than a 22-year-old who's trying to build their capital base. So a younger person typically will be more aggressive, but it's all about what's good for you. You know, a person that's got $10 million is going to take a larger amount of risk per trade than someone who's got $10,000. But this basic methodology helps you determine your position size because you know that the difference between your entry and your support price is your risk, and then you take that, divide it into your risk tolerance to come up with your position size. So that's how we limit the size of the losses on the trades that we take that are good trades. But we also want to avoid just simply taking bad trades. You do not want to buy stocks that have pessimism. You want to wait for them to switch from pessimism to optimism. So don't be a buyer when the stock's in a downward trend. There's a saying in the stock market, don't try to catch a falling knife. Stocks that are in sharp downward trends, they seem like they are good deals. But there's usually a reason why they're going down in price. There's usually something wrong at the company. Maybe it's the market itself that's bad. You know, we've seen the market drop all year because of inflation and rising interest rates. And of course, what's going on in the Ukraine with Russia. Those things have hurt most stocks, and it has brought pessimism to most stocks in the market. And so trying to buy in that environment is like trying to paddle a canoe up a river, trying to roll a big rock up a hill. There are pockets of strength in any market. You can always find something to buy, but it's certainly easier to trade with the trend than to fight pessimism. You don't want to hold stocks that break through support. So that's this thing here. If you've got a stock with an inflection point low at $19 and price goes down through it sharply, there's probably something wrong. We're going to look at some examples and I'll show that. And the support can be a trend line of support like this, which is drawn across the bottoms, or it can be a horizontal support. Don't trade against the trend. That really comes back to not fighting pessimism. And this is one that a lot of people don't get. They buy parabolic trends. Buying parabolic trends is dangerous because price almost always comes back to the trend line. Let's look at some examples. This is a company you may have heard of, Apple, and I'm going to show you why I told my brother to buy this stock about a week ago. But everyone look at that chart and think a little bit about the things that we've talked about so far. So start by trying to see the inflection points at the tops and at the bottoms. And then try to visualize who's in control, buyers and sellers, buyers or sellers. And then look for compression of volatility. Then look for breaks through resistance. Now, if you've never done this before, probably not easy. It takes practice. That's why when I teach people, I spend hours going through these with insightful, in-depth lessons to show these things. We're just trying to give you the basic overview today. So let's start with inflection points. You've got inflection point highs here, inflection point lows here. Sellers are in control because the tops are falling. Buyers take control because the bottoms are rising. So the buyers took control right here when they broke the downward trend line from a rising bottom. And then they did it again here. They broke through resistance at $146 a share from optimism, because we had rising bottoms, from low volatility, because the volatility had compressed, and that started the little upward move. Now, this is a swing trade, very short term. This chart is a 30-day, 60-minute chart. And so I told you my brother bought the stock. We were texting. He actually lives in Europe. And we were texting, and he was looking for something to buy. I said, you know what, I think Apple's pretty good. Their earnings are coming out, and the market seems to be predicting that their earnings will be good. And so he bought it right about in here. And then for these 2 days, price went down. And I think he was a little bit nervous because he asked me about it. And what I answered to him was, support has not been broken. So let me clear off some of these lines so you can see. The last inflection point before the buy signal was right here. And so unless it went below $142 a share, it did not give a signal to take the loss. So buying here, your entry is, let's call it 147 just for the sake of round numbers, and support is at 142. So your risk per share is $5. If you bought 100 shares, your risk is $500. And then earnings came out here. Stock went up sharply. It went up, I think, 7% on that day. So as a short-term trade to make 7% or 5% in 3 or 4 days, that's a good swing trade on a large cap stock. We can do much better on small cap stocks because they tend to be more volatile. I just like to use this stock because everyone's heard of it, and I want you to see how these things change over time. The sellers were in control for a very long time. We could go back even farther and see how long they've been in control. But the control changed around the 3rd week of October in anticipation of earnings. Why? Because the people that know the most came into the market and started to switch from falling tops to rising bottoms by being aggressive buyers. All right. So here is the energy sector, the Canadian energy sector. And this is an example of a parabolic trend. Remember I said you want to avoid these things? So there was a trend line, and it goes back a lot farther, the upward trend line. Up here, if you were to listen to the media, read the newspaper, everything would sound great. Full of optimism. Oil prices strong. Everybody was happy. The problem was price had run away from the trend line. And when price runs away from the trend line, there's a big disconnect between risk and what the mood is. The mood is very optimistic, almost irrationally so. And eventually the bubble bursts, and you switch control. So I never want to be a buyer when price is running away from the trend line. Okay, I want to be a buyer when you break out, but I don't want to be a buyer here. I want to wait for the pullbacks. So don't want to be a buyer up here, wait for the pullback to the trend line. Don't want to be a buyer up here, wait for the pullback to the trend line. Don't want to be a buyer. See how this does this over and over again? Pulls back to the trend line. Don't want to be a buyer up here, wait for the pullback. Now this time it pulled right down through it. So now the chart's broken. Now you don't want to touch oil and gas stocks in June of this year on the Canadian market. But more recently, we've started to build a rising bottom again, and we're breaking through this resistance. So it's looking better. Problem is it's going to find some resistance up here. So you got to be pretty picky about the stocks that you buy. Okay. So how do you find hot stocks? Very simple. We start by looking for abnormal activity. So look for stocks making abnormal price gains with abnormal volume from low volatility. Find the stocks that surprise the market. I love stocks where nobody cares, they're kind of quiet, and all of a sudden they come alive. And they come alive because something's going on. And if there's optimism before that and there's low volatility before that, they can often move up. Now, what I've given you today are the basics. There's more to this than what I've shown. I'm going to go into a little bit more depth on Tuesday's webinar for investors and then on Thursday's webinar for day traders. And I'll actually show you the tools that I've created to find these things quickly. Because it doesn't do you any good if you find it 3 months after it's been going up already. Okay, so here's an example. Nobody cares. Abnormal activity. Little bit of rising bottoms. Very low volatility. Abnormal price and volume. $2. 2 months later, it's more than doubled. Okay, another one. This was AGLE on Friday. Nobody cared Thursday afternoon. 3 o'clock, something started to happen. You can see it. The volume's coming in. The price action is good. And then it's simply a matter of getting in at the right place. I love to get in on those pullbacks to the trend line. So there, that's when I bought, and then I bought more right here. Sold it up here. Buy more there. Sell it here when it goes parabolic. These are all the things that I teach in my active trader course on how to day trade these situations. I've got lots of students or people, my subscribers and students, who just sit at home and day trade the stock market. Some people do it 2 days a week because they still go to their job. Other people are full time, and that's what we'll sort of get into on Thursday. So how can I help you do this? First thing everyone should do is make sure you're subscribed to my YouTube channel. It's all free. Just go to YouTube and do a search for Stockscores and subscribe to the channel. Click on the notifications bell. I put up at least one video every week where I do my analysis of the market. That's usually Sunday mornings. And so it'll be up tomorrow morning. I actually just recorded it this morning, but it has to be edited by my editor and then gets put up on the website. On YouTube. You've got free webinars this coming week. So again, if you want to register for those, just go to stockscores.com, go to the homepage. And if you just scroll down, you can see how to invest in the stock market profitably, day trading for full or part-time income. If you go to trader training, you'll see them all because there's actually more. Just go to upcoming events under the trader training menu and you can see them all. So this is today's. We're in that right now. This is only for members of Stockscores. This is where I actually have my day trading algorithms running in real time. But these are the free ones. So how to invest in the stock market profitably on Tuesday, November 1st. Day trading for full or part-time income on Thursday, November 3rd. And then for those that want to learn more about my courses and becoming a member of Stockscores and being able to participate in that daily day trading webinar that I do every day that the market's open. That's next Saturday at 9 o'clock Pacific. And so I encourage you all to register for these. You just click on it and register. And also everyone that registers is going to receive a free copy of my book electronically. It's called The Mindless Investor. You'll learn more about The Mindless Investor if you go into, where is it now? Stockscores analysis, trader training. Where did I put? Oh, here it is, right here. So that's the book. Because you've attended today's webinar, I will email you this book. Now, if you're watching today's webinar on YouTube or in the video recording, just make sure you attend one of the other webinars coming up this week, and I will email you an electronic copy of my book. I no longer have hard copies of it. It's sold out. I haven't gotten around to getting another run printed, so I'll probably redo it one day, and I just haven't had time. All right, so we can take some questions now. I think that was all I wanted to go through. There's the upcoming webinars. So fire away with some questions. We can look at a few stocks and then wrap up, and I'll be back again on Tuesday. So now, again, if you asked a lot of questions earlier, they scroll up, so I don't see them. Someone asked if I can analyze Bitcoin. So I do that in my weekly video. So I did that for tomorrow's video, but I'll give it to you now. I mean, you know enough now. Who's in control? Sellers, right? Falling tops. So I've been bearish on Bitcoin for a very long time. When it switched from rising bottoms to falling tops, that's when I started to be bearish. Now this week, there was a little bit of optimism. If you go into the short-term chart, let's make this a 1 month, 60-minute chart. You can see there's a little bit of hope happening here. You're starting to get rising bottoms. So I think that there's been some day trading opportunities in Bitcoin and the Bitcoin miners. So there's HUT, RIOT, MARA. They're all Bitcoin miners. And they actually gave some good day trades earlier this week. But as a long-term trader, it's still an uphill battle. So only in the short term would I touch it. Let's take a look at what other stock did your brother buy? He bought the one that was one of the ones that I did in last week's YouTube video. STMP? No, SMTP. I can't remember. No, if you go watch last week's video that's on YouTube, you can see the other one starts with an S. Someone might remember it. All right, how about what else we got here? Ballard Power. I like Ballard Power's chart, so I'm going to bring that. No, I don't. I was thinking Bombardier. Ballard Power's chart, ugly. Who's in control? Sellers, right? Stay away. Until this downward trend line is broken from a rising bottom, don't touch it. Stock scores are bad, bad news. Tesla. Another question here on Tesla. Who's in control of Tesla? Sellers. It is at support, so it should bounce off of this, and you can see it starting, but it still needs to really break these downward trend lines, start to build rising bottoms. Now that's for a position trader. But if you're a day trader, you're not looking at this chart. You're looking at the intraday chart. And there on Tesla, you see that there's some rising bottoms starting to build. So there may be an opportunity to be a buyer of Tesla next week if it can break out through that pattern. Okay, lots of stock questions coming in. I'm not going to be able to do them all, but I will try this one. TRP, bad, right? Sellers in control. Day traders, swing traders, okay, a little bit of an opportunity on this breakout right here from an ascending triangle. So a day trader or a swing trader could have bought it, but longer term investors should still stay clear of this. How about Roof? Roof is an ETF for US real estate. It's not good. It is breaking a downward trend line, so that's a step in the right direction. We look at the 3-year weekly, so to get the long-term picture, it is quite oversold. Okay, you can see how the lines are getting steeper and steeper. So I think there's a decent chance it'll come back up into here, but the long-term picture is still negative. Now make sure you tell me the different markets. So someone's saying Roof on the TSX Venture, so that's V.ROOF. There you've broken the downward trend line. You're getting a little bit of volume coming in, so it's better. Let me take a look at the little longer term chart here. So the good thing is it's broken the downward trend line. It didn't do so from a rising bottom. It's now building the rising bottom. If it can start to break up through 25, it gets interesting, especially if it does so on abnormal volume. I still don't think it's great, but I think it's getting better. T.FRU. And you notice how quickly I do this? Like I can look at this chart and instantly see what is good or bad. And that's just practice, and obviously knowing a little bit more than what I've taught you today. There's a little more to it than that, but you've got the basics now. So the buyers are taking control. It's quite volatile. We don't have low volatility. Let's take a look at the 3-year on this. It's in a good long-term upward trend. I would say this is a hold. I wouldn't be a buyer, but it's a, if you're in it, I would hold it. The yield has got a pretty healthy yield, 6.37%. So that helps. I don't know if that's sustainable, but good hold. I wouldn't buy it though. I just think it's a little bit risky. ASTL, bad. Okay, falling tops, not good. SOFI, fairly negative, starting to try to turn. It was actually on our day trading list on Tuesday, but still not quite good enough. EMR, in the short term as a swing trader maybe, but the long term not so much. Meta's ugly. Obviously a big gap down on bad earnings on Thursday, but there's no reason that anyone should be in this stock, because when did it switch from buyer control to seller control? Okay, there's your upward trend line. It broke down there, and then it broke down from a falling top here at $300. The first sell signal was at 340, second sell signal at 300, and it's never had rising bottoms. Now it's $100. It's a bargain, right? I wouldn't touch it until it can start to build rising bottoms and get an improving chart. Don't touch this stuff. All right, I'm just going to see if there's any other more general questions. I notice when there is abnormal volume, the price action is parabolic. So would you wait for a pullback before entering? Actually, that's not true. When you get a breakout, that's not parabolic, because I'm going to draw a picture to show you this. And this is, again, getting a little bit more in-depth kind of things that we actually go into in the course, but I'll just share this with you here. So if you have a stock that's in a sideways range and breaks out, this person's saying that's parabolic. It is not. Parabolic doesn't happen until you've defined the upward trend line. And the upward trend line is defined by pullbacks. So when you run up and you make a pullback and then move up again, that defines your trend line. And it's only parabolic when it runs up and away from the trend line. So when the trend first starts, that's not parabolic yet because you haven't defined the trend line. Again, that's a little bit more sophisticated than what I wanted to go into, but I wanted to just give you a sense of that. Can you apply this to investments like pension fund holdings with equity, bonds, etc.? Yes, anything that trades, as long as you can get a chart. Why did IM Gold go up this week? I believe, I don't know for sure, but I believe they sold a property and they had a bunch of cash come in. But I know it was abnormal this week, and I noticed it as well. And that's what I remember, but I'm not positive of that. You can go check the news on the company, it'll show you. Okay, here's a more in-depth question. What time frame durations do you have to focus on to ensure you are in an optimistic market? Current conditions are pessimistic, but Apple, for example, you showed turned around after earnings, but only on a month duration. So it's a good question. And this is actually what my video for my weekly video that'll be out on YouTube tomorrow goes into. But the duration that you look at is the duration you trade. So if you're a day trader, you should look at like a 10-day chart. If you're a swing trader, look at a 30-day chart. If you're a position trader, look at the daily chart or the weekly chart. All right, so if we go back to like Tesla, for example, on the 3-year chart, it's negative, right? Tops are falling. So if you're a longer term investor, I wouldn't buy it yet. If you're a position trader, look at the daily chart, still pretty negative. But if you're a swing trader and you're looking at the 60-minute chart, you're seeing that things are improving. And so it really comes down to how closely you can watch the stock and how actively you want to trade it. We've switched from falling tops and now we're starting to see rising bottoms that can break out next week. It may start a recovery. And then that will start to improve the daily chart. And then that will start to improve the weekly chart. It's a process that takes some time. And again, I go into that in more depth in my video this weekend. All right, I'm going to wrap it up now. Again, to register for the other events that we have coming, go to Trader Training, upcoming events, and then just go down the page a little bit to investing, which is on Tuesday, day trading on Thursday, And my courses coverage is on Saturday. They're all free. And I will be emailing you all the video for today's session so you can go back through it, because it has a lot of information. It might be a little bit much to soak in 1 hour session. And also, just for being here today, I will also be sending you all an electronic copy of my book, The Mindless Investor. And so that will come to you by email, probably not today. It'll probably be, I'm going to send them all out after all the webinars are done, most likely. So that'll be next week. I might send them out sooner. I just have to give that some thought. It's a bit of a process to send it all. But basically, you'll get a file and you have to download the file, and then you just open it with an ebook reader. And I give some links for the electronic book readers that you can use, and you just install that on your phone, your iPad, your computer, whatever, and then you can read the book that way. All right. So thank you all for attending this morning. I hope that you have a great rest of the weekend. Sorry I didn't able to answer everyone's questions. It's just so many people here today. But I want to thank you all for attending, and we'll see you all on Tuesday. We'll get a little bit more into the investing tools and process. Thanks, everyone. Bye for now.